Welcome to Sabio Traderoom. In this video, we will explore the peculiarities of trade execution. As you know, every market transaction requires two sides, a buyer and a seller. The broker or exchange connects them on its platform, forming an order queue for buying and selling while earning a profit from each transaction. This profit is called the spread, which is the difference between the buying price and the selling price. You can also see the average price on the chart, which is indicative, meaning that your trade will be executed slightly above or below the average price. On an hourly chart, this difference is barely noticeable since the spread on the euro-dollar is quite low. Let's switch to the smallest time frame, 5 seconds, to examine it more closely. Here, we can see two dashed lines above and below the average price. These lines move together with the average price, sometimes tightening or widening. The lower dashed line is the bid price, the price at which market sell orders are executed. The upper dashed line is the ask price, the price at which market buy orders are executed. The spread fluctuates depending on the market's liquidity. The more active the flow of orders, the lower the spread, and vice versa. During periods of high volatility, such as key macroeconomic data releases or speeches by central bank leaders and other influential officials, the spread increases. Another potential risk is slippage, which happens when a market order is executed at a worse price than anticipated due to insufficient liquidity. Let's open a trade and observe its execution in slow motion. We click the buy button. A few milliseconds pass, and the trade is executed exactly at the ask price at the time of execution. Now let's proceed to the trade closing. As we can see, it was successfully closed with a profit when the bid price reached the take profit level. It's important to note that to close this trade, the bid price had to reach the take profit level, not the ask price or the average price shown on the chart. This is why you might sometimes see the price touch your take profit, but the trade does not close. This is normal because the trade only closes when the bid price, the price at which sell orders are executed, reaches the take profit level. Since closing, a buy trade requires a sell order, it is always executed at the bid price. If you had an open sell trade, the opposite would happen. Your stop loss would be triggered a little earlier since sell trades are closed by a buy order, which is executed at the ask price. Now, let's analyze a stop-loss scenario. Since we currently have a buy trade open, it will be closed at the bid price, which is slightly lower than the average price. In this case, the average price also dropped below the stop-loss level. However, in some situations, it may seem that the trade closed earlier than expected, before the price reached the stop-loss level. This is normal, as the bid price is always lower than the average price used for chart visualization. Now you understand the mechanics of order execution for both take profit and stop loss scenarios. In the next video, we will learn how to work with investment volumes and convert lots into contracts, barrels, ounces, and vice versa.